Have you ever looked at the biggest, most powerful companies in the US and thought, how can I get a piece of that? Like an actual income stream. Well, today we're breaking down an ETF that's designed to do pretty much exactly that. We're going to see how it taps into America's corporate giants to target a pretty hefty annual yield. Okay, so let's start with the 30,000-foot view. The fund we're digging into is the YieldMax Target 12 Big 50 Option Income ETF. Yeah, I know, that is a mouthful, so we're just going to call it by its ticker, Big Y. And its whole goal is to try and generate defined income from, you guessed it, the titans of the US market. So the big question is, how do they actually do it? Right? How does Big SEG take a portfolio full of household names and try to spin that into a steady income check? Well, that's what we're going to unpack, looking at the mechanics right from the fund's own documents. All right, let's dive right in. To really get a handle on this strategy, we've got to start with what the fund is actually built on. What's at its core? So this is pulled straight from the prospectus. The fund's foundation is a portfolio of these big 50 companies. Now, its number one goal is income, and we'll get to that in a second. But it's also got this secondary goal. It wants to see the value of those investments go up over time. Capital appreciation from owning these massive corporations. So what does it take to make it into this Big 50 club? Well, the rules are pretty clear. The fund manager, Zega Financial, is looking for the 50 largest companies in the US based on their market value. They have to be based here in the US, and this part is super important. They have to have really active options markets. And to keep things fresh, the whole portfolio gets rebalanced every quarter. But here's where things get really interesting. See, just buying and holding these stocks, that's only part one of the game plan. The real engine that's supposed to drive that income objective is something else entirely. BIGY has this two-part approach. First, you've got the equity strategy. Simple enough, it buys and holds the stocks of these 50 giant companies. But then, layered right on top, you have the option strategy. And this is where the fund is actively trying to generate that defined monthly income. So, and this is really the key point here, while holding the stocks gives you the potential for growth down the road, it's the options that are the real workhorse. The prospectus makes it crystal clear that these option strategies are the primary driver of the fund's income. Okay, so let's pop the hood on that income engine. How in the world does selling options actually create cash flow for the fund? The magic word you need to know is premium. An options premium is basically the fee that the fund collects upfront right away when it sells an options contract. It's the money it gets paid for taking on a potential obligation in the future. Think about it like this. The fund is kind of like an insurance company for its stocks. It collects a fee, that's the premium, from someone who wants the right, but not the obligation, to buy or sell one of the fund's stocks at a set price later on. That fee just becomes instant income for the fund. Now, to generate these premiums, the fund has a couple of major tools in its toolbox. One is selling what are called covered calls. This means it sells someone the right to buy a stock it already owns. It gets that premium income, but the trade-off is it might cap its profit if the stock's price really takes off. Another tool is cash-secured puts. Here, it gets paid a premium for basically agreeing to maybe buy a stock later if the price drops to a certain level. Okay, so all of this complex work, selling options, collecting all these premiums, it's all being done with a very clear, very defined goal in mind. And that goal is a big one. The fund has an annual income target of 12%. This is the big number, the headline that the entire option strategy is engineered to go after. But, and I cannot stress this enough, it is absolutely critical to understand what this 12% really means. The prospectus is very, very clear. It is a target. It is not a guarantee. The fund aims to pay this out in monthly chunks, in distributions. And remember where that money is coming from. It's from the options premiums, not from the tiny little dividends you might get from the stocks themselves. And again, there is absolutely no assurance the fund will actually hit this number. Now, as you'd expect with any strategy that's shooting for a high yield like this, there are specific risks involved. The fund's documents lay them out, and it's really important we go over a couple of the big ones. First up, there's what's called derivatives risk. Since options are derivatives, their prices can be way more volatile than the stocks they're based on. Sometimes they don't move in perfect sync with the stock, and that little mismatch can lead to some unexpected losses, sometimes even bigger than the amount you invested. Another really important one is NAV erosion risk. So every single time the fund pays out that monthly distribution to its investors, the fund's share price, its net asset value or NAV, is expected to drop by that exact amount. Over time, these regular payouts can slowly but surely wear down the fund's core value. So when you look at the BIGY ETF, you're really looking at a very clear trade-off. On one side, you have the strategy that's aiming for a high target income from America's biggest companies, paid out every month. But on the other side, getting that income requires these complex option strategies that come with their own unique set of risks. The biggest takeaway is really about balancing that potential for income against the risks of the engine that's designed to create it.